Hello, hello, hello. Hi, gentlemen lurking in the corner. Come on in, grab your seats. Hello, and let me ask all of you early birds here on time, in your seats, how's everybody doing this morning? So just this one gentleman saying excellent is not going to work for me. I said, how's everybody doing this morning? Okay, that was like a very light golf clap. Maybe you haven't had your morning coffee yet. Maybe you were taking advantage of last night's open bar. But I want you to know that we have an incredible lineup of close to 55 speakers and 14 presentations, not to mention the fact that you're going to get to meet capital providers, gain industry knowledge, and have a chance to network with some of the biggest deal makers in North America. Being here will make you more successful and, frankly, more rich. You're welcome. So I'm going to ask you that question one more time. How is everybody doing this morning? If these gentlemen in the front row can muster a clap, so can all of you. Thank you for that. This is ACG's 17th anniversary of Capital Connection. I am Jessie Cruikshank. I am so honored to be here as your host for the 6th time in a row. This is my 6th year with you, and that means that I have been with all of you through Trump's election, Trudeau's elections, China's economic rise, the legalization of cannabis, Trump's tariffs, fears of a recession, gains in the tech industry, busts in the energy sector, and yet I remain steady. I am like, yes, a good stock. I am not volatile. I am never overvalued. I am safe. I am secure. I am consistent. I've got real market longevity, and I am so happy to be here again to guide you through the day and securely remind you where the bathrooms are, which men over here and ladies over there. And while I remain the same, you might have noticed a few changes to previous years. So we are going to have our main plenary sections right here in this room. Our workout and breakout sessions are going to be upstairs, as they always are, but our exhibit halls and lounge are now located in the ballroom, and mainly because we wanted this year to be all about networking, to really give you a little more space to sit, to meet, to connect with colleagues and do business deals. So that's how it's all going to work today. Let us know if you get lost. If you have any questions, we'll always be here to guide you. And speaking of networking, how many of you were at the opening reception at Ricardo's last night? Show of, yes, you don't have to clap, just a gentle show of hands. Okay, excellent, and you're here this morning. Isn't that a gorgeous space? Spectacular. It was just ranked the #1 wedding venue in Toronto by Today's Bride, but I'm sure our networking reception for the Association for Corporate Growth was just as romantic. And speaking of romance, yesterday we featured Deal Source at the Fairmont Royal York Hotel. Show of hands, how many people got to check out Deal Source? Excellent. We had our biggest turnout yet. It was a huge success, so I hope you all met the investment banks of your dreams. And if in-person connections aren't your thing, we have an app for that. You can connect directly to all of your fellow attendees digitally with this year's mobile app. It's proudly sponsored by CIBC. So I want to hear it. If you have it downloaded already, throw your hands or your phones up, okay? Okay. There's a handful of you have it downloaded. Most of you have not, so here's how you're going to do it, because we really want you to grab it. Just visit the App Store, download the Attendify app, and then search Capital Connection 2019. You're going to find the conference program, sponsor and speaker profiles, and best of all, that is where you can also communicate with your fellow attendees. It really is part of the connection portion of Capital Connection, so make sure you get that on your phone. If you're having any issues, please see one of the lovely ladies at the reception desk for assistance. And while you're on your phone, last reminder to follow at ACG Toronto on Twitter. It's at ACG_Toronto. Tell all your friends that you are here living your best lives at Canada's largest debt and equity marketplace. I know Brent is, right? Brent, you just tweeted. Yeah, he tweeted a selfie, so make sure you check that out. And now it's my honor to bring someone up who is definitely living his #best life as ACG Toronto's chair of the board from DLA Piper. Please welcome Vaughn McClellan.
Thank you, Jessie. It's wonderful to have you as MC again this year, so welcome back. Good morning, everyone. As Jessie said, I'm Vaughn McClellan. I'm from DLA Piper here in Toronto and chair of the board of ACG Toronto. We have an awesome day ahead of us here with Capital Connection 2019. This is the largest conference of its kind in Canada. And it's only one of 30 or more events that we put on with ACG Toronto here through partnerships with other ACG chapters, sponsors, and strategic partners. So after today's conference, we hope you'll see the value in ACG events like this and continue to be part of future events. Now, as you can appreciate, a tremendous amount of work and effort's gone into today's event. The people on the organizing committee, our sponsors, and many of our speakers are all part of a pretty intimate group in the Canadian mid-market investment community. They're our colleagues, our friends, and our supporters. So please take a moment at some point today to notice our committee members, sponsors, and speakers, and when you have a chance, please recognize and support them as well. So I'd now like to invite our co-chairs of this year's conference, Adriana Sorney from Persistence Capital Partners and Jonathan McCarthy from Venn Capital to the stage.
Good morning, everyone. As Juan mentioned, I'm Adriana Chorney, a partner with Persistence Capital Partners, and welcome to the 17th Annual ACG Capital Connection. We have a great program today that the committee's been working very hard over the past year, and John and I are thrilled of what will be one of the biggest conferences that ACG's ever had with a record number of attendees. Thank you to everyone for making it out last night at the opening reception. It was a great evening, fantastic venue. And also a big thank you to the Canadian Women in Private Equity for hosting a pre-reception in partnership with ACG Toronto. It was a great way to end a very successful third deal source that also took place yesterday. As Vaughan also mentioned, it's the largest conference of its type in Canada and one of many events that ACG puts on here in Toronto. For those of you who don't know, ACG well, it's a global network that includes 59 chapters, 15,000 executives, and 1,200 events across North America and Europe. It's a phenomenal opportunity to connect, and after today's conference and hearing more about our deal source yesterday, we hope you'll see the value in ACG and events like this and consider joining as a member.
Hey everyone, John McCarthy. Great seeing everyone here today. Last year we don't have the same tenure as Jesse, but we were out in the audience, and before we hand it back, we just want to announce next year's co-chairs. We had the honor of sitting in the audience and being named last year. So with no further hesitation, Melissa Lee from CIBC is going to be up here next year along with Michael Rudanich from Sun Life. So a little round of applause. We will be supporting them next year. And with that, back to Jesse.
One more time. Thanks, guys. One more time, let's hear it for Vaughn, Adriana, and Jonathan. And really the entire board and committee for putting so much time and energy into making this happen. Let's hear it one more time for them. Thank you, everybody. I also think it is worth noting that Adriana is the first female executive to co-chair a Capital Connection in 17 years. I mean, Jonathan, like, you're okay, but Adriana is making history. So let's have a round of applause for that. And diversity is something you're going to see more of over the course of today's jam-packed schedule as we delve into this year's theme, which is investing in a low-growth recessionary period. And I know I said the R word is a sensitive word. Some people don't like to say it out loud, but it is coming. Honestly, I had my doubts. I thought it was fear-mongering, everybody talking about the recession. But then I saw this pop up in my feed, and I thought, that's it. If there's a Shaq meme about it, it's confirmed. The recession is happening, people. And as a millennial homebuyer right now, this speaks to me on a very deep level. So I'll be paying close attention today as we cover what's to come, what's happened since the global financial crisis, and where we are right now. And not only does today feature the greatest depth of content we've ever had, you're going to want to stick around for the closing reception to really make the most of the networking opportunities. That starts at 4:15. I believe there is alcohol, so don't miss it. And now our opening panel is sponsored by BMO. It's kicking things off today. It's called Titans of the Industry for a reason. We're about to bring some of the most senior people in the mid-market sector onto this stage. We have Brent Belsberg from TorqueWest Partners, who mentioned that he was the first official keynote speaker at the first ever Capital Connection 17 years ago. Is that true, Brent? Brent, I wasn't even born. Wow. Brent, a legend, is in the room. David Nowak from Brookfield Asset Management, Seth Mursky from Onyx, John McIntyre from Birch Hill Equity Partners, and Pascal Tremblay from NovaCap. What the Backstreet Boys are to me, these 5 gentlemen are to your industry. So I want you to scream at the top of your lungs as I welcome them to the stage with our moderator from BMO, Nadeem Herji.
Just because I'm the oldest. I think McIntyre is almost as old as me.
All right, well, good morning, everyone. My name is Nadeem Herji. On behalf of myself and the BMO Financial Group, I'm excited to have the opportunity to be the moderator for what I can only describe as an extremely distinguished and accomplished panel, and one that I think is perfect to talk about what we learned from the past, how we feel about the present, and what are we thinking about the near-term future. Now, we are already late in the cycle, or maybe that is an old way of thinking. To me, the question is not whether we're late or early in a cycle, but what kind of cycle is this? Maybe it's different now. Maybe there's a new norm versus the deep highs and lows that we're all used to. Or are we just waiting for the slightest inclination of a problem so that we can create the next cycle? It's already the longest U.S. expansion since World War II, and many signs are suggesting that we are in the late innings. Labor market is tight, interest rates are in the neutral zone, but there's a lack of wage and inflationary pressure, and that's afforded the Fed the luxury of continuing to cut rates. And that in itself may, in fact, extend this already long expansion period. Now, BMO's not forecasting a recession at this point, but we do acknowledge that the probability of one has definitely increased. So we ask ourselves, what will be different in the next downturn? And as importantly, what possibly will be the same? Unless we experience an unforeseen shock, BMO expects the next downturn to be a bit more textbook-like than what we experienced in the global financial crisis. In other words, central banks will end up tightening to the point that the economy will simply roll over, so to speak. The resulting contraction would be expected to be much more modest than what we experienced in the global financial crisis, which, when you think about it, was really about an excess in housing and a retrenchment in the credit markets. But enough about what I think or what BMO thinks, as we are here today to hear about what the 5 titans of this industry think. Each of them are handpicked because of their experience, their credibility, their track record, and frankly, their importance to the PE industry here in Canada. And because each of them have successfully navigated through the global financial crisis extrememely successfully in their own rights. Although, in looking at them today, I'm realizing they've maybe gone through a few cycles. I was one of those guys. All right, so without further ado, let's start. And we'll try and leave some time at the end for questions, so everybody will get a chance to ask some questions at the end. So Dave, I'm going to start with you. Interesting opportunities can often be found in periods of economic dislocation. Did you find opportunity during the global financial crisis?
Yeah, the global financial crisis was really a transformative time for Brookfield in general. If you think back into our history, at the time we really were just what I'll say a generalist merchant banking organization. So we invested in all different kinds of asset classes. But at the time when the markets were melting and people were paralyzed, the decision was made to try and make a handful of sizable transformative investments. And so coming out of that period, what we did was we put $6 billion to work in primarily 2 investments. One was General Growth Properties, which was the second largest retail shopping mall business in the US, which really helped catapult our real estate business. And probably the more important one was we bought Babcock & Brown, which was a large infrastructure business. And we originally went in and sponsored the recap. We bought a couple of assets out, and those assets actually created the foundation of what is now our infrastructure business. And Sam Pollock, who runs our infrastructure business, is now raising a $20 billion fund. So if you think about the limited amount of time that's passed since then, and what those opportunities actually afforded us to do. It set us up where we've now become really real estate infrastructure and private equity as a firm.
Okay, thanks. Maybe Brent, I could ask you from a Torquest perspective, what strategies or actions did you use during that period?
Yeah, I think the difficult part was that in 2008 and 2009, no one wanted to sell us anything because everyone was holding on to their assets and hoping that the banks weren't going to take them away from them. But for sure, our best transactions that we've ever done were done in 2009, 2010. And it just shows that we all think we had a lot of value, but timing makes a big difference to all of us. And the time in the cycle you get to buy things are important to all of us. I think we've all, almost everyone on this panel has also raised significant amounts of capital right now in anticipation of being able to get similar opportunities over the next few years. And so we're all looking to take advantage of that as well.
Okay, thanks, Brent. Seth? Following the global financial crisis, how long did it take before the expectation of sellers came in line with what purchasers were willing to pay? And of course, M&A started to pick up.
I'll kind of echo what Brent just said. I remember it very well because during 8 and 9, just as Brent said, it was very difficult to buy or sell anything, so not much was happening, at least in the private equity markets. In October of 2010, we made our first significant acquisition when we bought Tompkins, a UK public company, for around $5 billion US. And I remember struggling mightily to cobble together $3 billion of, $3.5 billion of debt. And just, you know, despite all our arguments, just couldn't seem to get it done. Finally got it done. And then within 3 weeks, so this is October 2010, we got pitched on a $750 million dividend recap. And that really, for me, marked the turning point of the debt markets and therefore the availability of capital to restart the M&A cycle.
Okay, thank you. Pascal, can I ask you to maybe comment on what Seth just said or maybe provide a perspective from Quebec?
I can only echo what Seth and Brent mentioned. You know, for us, coming into the crisis, we were lucky because we had just raised 2 new funds and we were flush with money. The good news is we had money. The bad news, we could not invest it for 18, 20 months. Everybody was waiting for us on the sidelines. And most entrepreneurs in Quebec was less touched, I'd say, than the rest of Canada, less of North America, because it's mostly smaller companies and less leverage and everything, but they were still on a wait-and-see approach. But when came mid-2009 and 2010, the market reopened, and what was very interesting from our perspective, the NovaCap perspective, we used that as a springboard to go rest of Canada in the US as well, because what we witnessed is that the Canadian credit, the banks were much more open than the US to lend at that time. So that's when we did a very good entrance in the US. We did several deals in the US and outside of Quebec, and that was very good for us during that period. And just like Brent said, better be lucky than smart, and when in downtime, if you can benefit from those lower valuations and good enterprise and decent leverage from our Canadian banks, we did very well in that period, for sure.
Okay, thanks. John, as a successful investor and business builder, can you share lessons learned during the global financial crisis?
I think the big lesson was, you know, as people have said, was to be opportunistic and see opportunities, the abilities for companies to come through it and succeed. I think the other piece besides that cyclical aspect is, you know, we spent some time a few years after the fact trying to dissect what had gone really well and what hadn't gone so well for us through that period. And it's sort of an obvious point, but when we keep after relearning, and that's the quality of the people running the businesses. And so it led us on a path to really redouble our efforts on how we think about putting leaders in place in companies and what skills and character that they need to be successful, because they are going to face tough times. And so that, I think, from a lesson learned was a big takeaway for us.
Okay. Pascal, any advice from you?
You know, we did a similar exercise, and management is key in down cycles, but acting fast is better. You know, most of the time, and I know it's been said over and over from private equity guys, we are slow sometimes to change management, but in down cycles, you have to change quick, right? And that's what helps the business. And resizing, don't be afraid of acting fast. That's what we learn a lot. And from an investor's perspective, being patient, conservative, keeping a lot of dry powder helped a lot, you know, and everybody knows that if you're over-levered going into a down cycle, it's going to be tough on you guys. But on the buying side, what we used a lot in the down cycle was certainty of closing. You know, from the seller's perspective, and it's funny because when we look at those statistics in the funds we invested in down cycles, 7 out of 10 investments were from broken auctions because we had certainty of closing in our hands. We had the financing, we had the money, we could convince them that we were going to close at the value we were presenting to those companies. So it was a very, very useful tool for us to pitch to sellers that we were going to sell at the price we were mentioning. Not the overprice, but the fair price we were telling those businesses. And that was very, very helpful for us.
So you're saying by having balance sheet capacity, you were able to get better value due to certainty of closing with the seller.
And I say, you know, when you go in the community and consistency and of closing for the people, and then you can pitch it to all the partners, to the investment bankers, to all the community. You know, having this type of reputation helps a lot in a down cycle. It's totally irrelevant in up cycle because everybody is very excited, but in down cycle it helps a lot.
Okay, thanks, Pascal. Okay, so let's move on to how we thinking about the present day. So Dave, what is your assessment of the PE sector today, and can you also frame it with what's top of mind for you today in terms of macroeconomic fundamentals or trends?
Yeah, so we've never been particularly good at macro style investing. Generally, when we've tried to take views from a macro perspective and invest behind that, we tend to get it wrong. So what we do is we think about all the macro considerations. You mentioned negative interest rates. That's something that we tend to spend a lot of time thinking about, but it's one of the many variables that go into the investment decision making. What we try to do from our perspective is figure out what we may be good at or what we may have an advantage on. And our simple approach has been that we don't particularly think we're smarter than anyone else. There are much smarter people out there. There's lots of capital. Our advantage is in the information that we may have in being a global asset manager. And so when we look at opportunities, it's less about the macro stuff or where we are in the market. It's about, do we have information that other folks, some of the guys on the stage, that may not have access to that information. And so one example would be our private equity group. We just bought the Westinghouse Nuclear Services business. This was a business that when it came to market, most people's reaction was it's nuclear, it's in secular decline, it's probably not a good opportunity. We have within Brookfield a pretty large global power business. So what that allowed us to do is to go talk to our guys in the power group and do an actual bottoms-up build-up and come to a real view on the nuclear industry and whether it was a melting iceberg or a melting ice cube. And so anytime we're looking at investing, regardless of what cycle we're in, a big focus is, do we have an information advantage that others may not have, and therefore be able to find value in the opportunity.
Okay, thank you. Brent, where do you think we are in the cycle? And maybe I'll add to that, how do you feel today compared to, say, 2006, 2007?
I don't know why people keep asking me what happened in the 40s. I'm kind of feeling a lot older up here than I used to, but you know, it's interesting. We've had an 11-year run, right? So that's not traditionally the case. Traditionally, you see recessions a lot faster than that. So none of us are able to call it. No economist is able to call it. You heard what you said in the initial run-up to this. You sit at another bank meeting next week, you'll get a different answer. So if they don't know and they spend 100% of their time at that, none of us really know as well. But you live in a world where you have to make decisions. You have 5-year funds, and you're supposed to invest them in 5 years. And yeah, they might give you a year or two more, but you're obligated to put the capital out in that period of time. The benefit is that you don't have to sell them, and you can ride through different periods of time and come out the other end. So, you know, none of us can call where the world is. We can move our portfolios slightly to more consumer products as opposed to industrial products, to ones with greater cash flow, greater free cash flow from others that have more CapEx requirements. You can get benefit in your in hiring better people into your business than you had before. You can put your balance sheet in place so that you can ride out certain cycles if they happen, and you can be more disciplined in what you buy. And I think all of us we're all Canadian based, and we all have access to transactions around the world. And so even though we're in many ways generalist Canadian funds, generally Canadian-based funds, we're all looking for that little angle that David talked about, that little bit of expertise that differentiates us from anyone else, and usually comes from lessons learned in previous funds. And so I think there's a big benefit to having been around a while, despite the fact that obviously I think that. But it's hard for new funds to start out without that base of expertise, because the young people who come into these funds have never lived through 2008 and previous recessions. So that's our value add as a group on this stage to the people in our organizations.
Seth, can I ask you the same question? Where do you think we are in the cycle today, and how do you feel versus 2006, 2007?
Sure. Being only half of Brent's age, I don't have quite his perspective.
That's true.
I don't think I don't think there's very much parallel to where we were in 2006 and 7 at all. If I look at 2006-7, housing starts were over 2 million. Housing starts now are around 1.2 million, give or take. Gasoline price, or oil prices, sorry, were over $125 a barrel. They're about half that now. Home equity loans were over, I'm giving U.S. statistics, sorry, I should say. Home equity loans were over $600 billion. They're a bit more than half that now. So there's just none of the kind of foam and froth that there was in the pre-crisis era. And I would actually argue that for large parts of the U.S. economy, we're in a mild recession right now. The oil patch has been very difficult in the U.S., and that drives a big part of the industrial economy in every country that has a significant oil patch. Capital spending has been very anemic over the last year with all the noise and uncertainty around tariffs. So that's come off a fair bit. The consumer is still hanging in there, God bless them. But even consumer spending around the important demographic of young people, drive the growth forward. And unfortunately, we have a generation of young people that are saddled with student debt. And that's a huge burden for marriage and family formation, birth rates, you name it. It's an anchor to growth. So I just don't see the bubble outside of a few categories that's going to cause the kind of downturn we had last time, and would argue we're kind of in a slow, mild downturn as we speak.
Okay. Sort of along that path of what Seth just talked about, Dave, what do you think, if and when there's a next downturn, what do you think will be the same, and what do you think will be different?
Yeah, I'm with Seth. None of us think that that's going to come in our lifetime, or certainly my lifetime as an investor again. I think when the recession comes, it's going to be much more muted. I think the indentures don't really have any teeth in them, so the opportunities to go in and create catalysts to restructure businesses just won't be there. I think one of the things that's different, though, too, is people are probably better prepared on the GP base. So we internally, and maybe it's some of our revisionist history about how we had some success in the global financial crisis, have been proactively preparing for opportunities. And so a good example, Seth mentioned the price of oil. We regularly inventory ideas of investments that we would like to own, but can't own because there either isn't a liquidity need or there isn't a catalyst within the capital structure. And when oil is about 2015, the high yield market compressed and oil originally went down to around $30. We had a number of names that we'd done a base level of public company work on to be able to buy in higher in the capital structure. So you could buy bonds at, call it 75 cents in relatively stable oil patch-based businesses. Then what happened is January 2016 comes around and the high yield market opens back up, the bonds trade up to par. Didn't lead to a fulcrum security and the catalyst of a restructuring. So I think people are more proactively prepared. They've got an idea around 10 or 20 names they'd like to own, but I'm just not sure that the catalyst will be there for people to acquire these names.
Okay, thank you. Okay, so we're gonna maybe shift our focus now into where we think the future is, and really want to talk about how each of your organizations have been preparing for the future and for the next cycle, and perhaps we can frame it a little bit around people, process, and strategy as a framework. And when I think about BMO, in our organization, one of the most important topics that we talk about at the boardroom tables is human capital. It'd be interesting, I think, to understand for everyone today where we're at and where you think we're going in the future. Are you hiring any differently in terms of the people leading your portfolio companies, or for that matter, are you hiring any differently for the people that you're bringing into your own organization? And maybe I'll pose that question firstly to Brent.
Yeah, I mean, we're all learning from what happened in the past and trying to plan into the future. So in certain industrial areas, we've hired very senior executives to come and join our team. Actually, as part of our deal group, we just hired the guy who ran chemicals for Bain out of Houston. He came to join us as a member of our team and has very little deal experience, but helps us in an industry that we have a lot of expertise in and have done 7 transactions in, all of which have been pretty successful. So, we'll build around that. We also hired a guy who does nothing but lean manufacturing because we think we have value to offer to our existing companies as well. Traditionally, we relied on the management of those companies and thought that that expertise would help us as well. We've also taken the opportunity to move a couple of the young people from our organization into our operating businesses because we think their skills are better suited than traditional CFOs inside some of the businesses we have. So they have the combination of accounting skills plus some investment banking skills. And as a result, we think they provide value as well to those businesses. So for sure, we're learning from things that happened over the last few years and trying to ensure that over the next little while that we provide some additional skills to the people.
Okay, great. Seth, how about from an Onyx perspective?
Yeah, I would just maybe build a little bit on the themes that Brent outlined because they're not too dissimilar. We've spent a fair bit of effort over the last 3-4 years hiring specialist talent, actually at the worker level. So we've got focus on procurement, focus on supply chain, healthcare, which is a huge. Healthcare is actually really our largest non-labor cost throughout the portfolio. We spend over I think $500 million US a year on healthcare benefits throughout the portfolio. So it's become a real focus of ours to be proactive at trying to get that down. IT systems, always a challenge when you're buying businesses that you haven't had the luxury of owning for several years, to understand exactly what their systems capabilities are and aren't. So we're going to be focusing dedicated talent in that area as well. And then just our hiring approach generally is becoming more, I'll say, disciplined or standardized, in that we're recognizing that not everyone does the same quality of interviewing, researching, and the like. And so we're putting stronger parameters around how we're hiring our most senior executives, because I'm sure, as everybody would say, that makes a profound impact on outcomes when you own a business. So we're trying to make sure that everybody that's in a position to hire senior leadership is doing it in a consistent fashion, with a clear scorecard on what you're looking for in terms of attributes, and discipline in understanding whether or not your candidates are meeting those scorecard objectives.
Yeah. Oh, good advice. It seems like just a common theme here is going into the future, specialization and perhaps operational excellence and expertise in-house is going to probably become more and more important for successful private equity. John, are you using more data when you think about your diligence, or more importantly, in terms of value creation initiatives?
Yeah, that's been a very large initiative for us for the last number of years. I would say it started when we were getting a lot of survey information around companies about areas like unvended markets. So we had two companies in particular that had very large unvended markets that we knew from survey information, but we had no way to drill down and say, well, who were those customers, those unvended customers that the company hadn't reached yet. And at the same time, we were seeing sales force turnover was quite high. So it put us on a path to start looking at the very large amounts of public data that's available, but the data that sits inside particular companies, and in fact our portfolio companies as a whole, and built a team internally, and then started adding people into our companies to drill down into that and say that if there is an unvended market and you're putting a sales force into Manhattan, who are the customers that sales force is actually going to call on? And that work is very difficult to be outsourced to consultants because it happens over a long period of time. It takes detailed data cleaning. It takes ride-alongs with salespeople, to the point that you could actually end up with salespeople on a weekly basis having warm leads on who they're going to call on. And so suddenly the sales force productivity goes up, the turnover goes down, and we're able to start getting that type of top-line growth. And that exercise has then expanded. So we're using data now. It's an important part of diligence, because again, understanding where markets are or understanding where costs could be is important. Right through to things like how do we interact with Google across our portfolio, because they're, as a monopoly, have tremendous power. So how can we present ourselves to them in a way that we can actually save some money? So it's become something that is very deep in our organization, but is also actually, we've got people in portfolio companies now as well interacting on it. So it's a major thrust for us.
Okay, thank you. Pascal, when you think about the future at NovaCap, are you underwriting any differently? Or when you think about your investment committee conversations, do they feel different than 5 or 10 years ago?
They are, I would say, totally different for two reasons. Mostly because in the last 10 years, NovaCap grew by 6-fold and the investment team grew by 3 times. So that changed a lot of the dynamics. But more importantly, nowadays, the investment pace is frenetic to do deals. And this has changed. I think it's there to stay for a while, even though we might have a mild to recession, because we see, we used to have, as an example, 60, 90 days exclusivity. Now we're lucky if we got 30 or any, right? And when you go to management presentation, you have to have your debt syndication guys, your lenders, your insurance guys, your consultants, and all lined up. And it used to cost $500K to do lower middle market deal. Now it's $2-3 million up front before you know you have exclusivity. So for that main reason, the IC discussions have changed a lot. And you have to have, like you mentioned, specialization in the team, like a debt syndication. You have to really be prepared and nimble to be able to transact in this market. And to show value is very important. And we also have, along the same lines as Brent, we have an operating team that we're building, very focused on operations in our company. And this has become a value add and a pitching argument to show to management team so we win these deals. And that helped a lot as well. And what changed a lot also, and I think it's here to stay, is regulation coming into the private equity world. I think private equity is now the new public market, at least in my mind. There's a lot more companies that are going the private equity way than going to public market. Easier, faster, less regulation. But we still have those regulations. Canadians investing in the States now, we have the CFIUS, we have the FERPTA, we have the ITAR, we have all this going as hurdles, whereas the US guys might not have that. So you have to be able to maneuver into this new environment. And we just did a couple deals in Europe, and we had to take, I think we had 13 jurisdictions that we needed approval from the government. And I think regulation is here to stay in our private equity world, and it's going to increase over time because we're taking more and more space in the whole world and perspective. So that, all in all, has complicated a lot the IC discussions when we do a deal.
Yeah, definitely lots to change. Dave, based on how you look at the future, for Brookfield, have you focused or broadened your strategic focus at all?
Yeah, we historically were investing in pulp and paper and mining, which weren't particularly good businesses. We would refer to them as sort of the dinosaur subset of opportunities. And Brent was talking about trying to find better businesses, maybe higher free cash flow generating opportunities. So we realized that we needed to broaden the funnel of sectors that we looked at. But it's a delicate thing because it's a lot like turning a ship. You can't lose your way and start to do stuff that you're not equipped to do. You don't have the scars on your back that are relatable. And so we have started to invest in the healthcare space. We view that as very operationally intensive, which is something that we have a history of being involved in. So we bought the largest independent health hospital network in Australia as our first healthcare investment. But one of the things we've consciously decided not to do, because sometimes in our business, the more important decision is not what you invested in, but what you decided not to invest in. We've taken a view internally that we're just trying not to invest in commodity-influenced businesses. Now, that's tricky to do, but where commodity has an impact on the investment, you have to have some kind of a mitigating strategy. And yesterday, for me personally, was a tough day because I had been involved with selling our palladium business, and we entered into an agreement to sell it about 3 weeks ago, and yesterday palladium hit an all-time high of $1,800 an ounce. Normalized rates are more like 900, so double what they would be. And all my partners told me I sold too early. And what I said back to them is, I guarantee you, if we hadn't entered into the deal, it would have gone to 1,000. So it's hard to buy good businesses, do all the heavy lifting, and then have the volatility in the commodity prices, undo that good work that you've done. So we've decided to stay away from commodities.
Okay, thank you. That's a big change for Brookfield.
Yeah.
I want to talk a little bit about disruption, and maybe Brent, I'm going to direct this to you to understand how you're thinking about it. When you think about disruption, are you investing behind disruptive business models, or are you more thinking about disruption from a due diligence perspective when you're looking at possible acquisitions?
It's a very interesting time because all of us are value investors and have always bought based on value, but where multiples are in today's world, it's very hard to just be a value investor. You have to add growth models to value acquisitions. In order to do that, you can't do that without awareness of what's going to disrupt your industry and how it's going to disrupt your industry. And so in every decision we make, the risk page is the first 3-4 pages of the memo. The opportunity page follows that. So many of us are trained as credit guys originally, and so our views always are based on the fact of what our downside is on something before we start to look at where our upsides are in the transactions we're looking at. So yeah, you know, we're very aware of disruptors, and you know, the average age of our investment team would probably be early 30s, right? So they're very aware of what's happening in the world and what changes are occurring in the world. But having said that, most of us on the stage start out as value investors, and we're trying to find that opportunity that something is available at something less than where we see the value being. And it's interesting that for all of us on this stage, we live in Canada, our home bases are in Canada, yet the amount of commodity-based activities that any of us undertake going forward is really pretty small. And we all hope it's nothing. But it isn't nothing, because it's really hard to live in Canada and not have some influence from what's happening in those sectors.
Okay, thanks, Brent. John, when we think about technology, we all know it's having a material impact on the business models that we look at. It's reshaping competitive dynamics, it's reshaping industries in general. So how has that impacted or changed your investment approach?
So it's an underlying theme and everything, but it isn't a critical factor for us in how we look at investments. We're very aware, or, you know, to Brent's point on risk and how technology can disrupt, but there's also the playing offense on technology as well. How can companies use technology to succeed and grow and be successful? So I would say, you know, we've probably seen certainly in our portfolio companies and within our own firm as well, that we have more talent and more human resources against technology. I was at one of our companies yesterday. They have a senior vice president there, and that's his full job, is technology. What opportunities exist and what threats exist against that particular company as it relates to technology. How can they use AI to better run their operation? What service providers are out there? So the pace of technology change is faster than it was, but I was reminded by them yesterday that Jeff Bezos was Time's Person of the Year in 1999. So, you know, it's always been a theme. It's always been, you know, underneath success and failure in investments, but it isn't something that we particularly focus on as an opportunity, a unique opportunity.
Okay, thanks, John. Pascal, NovaCap has recently launched a specialized finance fund. I thought it'd be interesting if you could provide the audience with some insights on what is it that you're seeing in this market and where you want to take this fund.
Sure. The financial services industry in Canada is about 7% of GDP. But what's most interesting to us, it has grown double the growth rate of the GDP for the last 10 years. So, and it is vastly dominated by the oligopoly of banks and large insurance co, for sure. So, and this left a very fragmented market and all the other parts of the financial services. So for us, we've been looking at this market for a long while. We saw a slew of deals that we didn't feel we could execute in our diversified industries and our TMT funds. So, and given regulations involved and very, you know, we didn't have the scars on our back, as David mentioned, so to be in that market. So we decided to create a team and raise a new fund for this market, basically. We will look at non-bank lending, which is a very strong growth in Canada. Private credit, non-bank lending is one of the fastest growing sector. Specialty insurance. You know, in Canada, we see that there is at least 25,000 small brokers of less than 5 people. Very, very fragmented space. You know, the P&C insurance market is very, very fragmented in all provinces in Canada. You know, We're also looking at specialized outsourcers for finance companies. Fintech is less so for us because we're more buyout guys than venture capitalists at this point, but this market will evolve to be a market of opportunities for us. So this is what we're looking at in a nutshell with that type of funds. And we see a lot of deal flow recently, but the last 3-4 years.
Okay, thank you. Remember our deal, you build them and BMO will buy them. So.
Absolutely.
Dave, when you look at investment opportunities in the future, do you see it differently in Canada versus in other parts of the world?
Yeah, we have a culture and a history to try and go where capital's at a scarcity. And so a few years ago, we bought the largest municipal wastewater treatment business in Brazil. We bought it at a time where corruption was quite public in Brazil, and people generally were uncomfortable putting capital to work there. So we do look for those opportunities in individual markets. We don't have a crystal ball to know where we will be going next. But when we do that, one of the things that we're very mindful of doing is we have a general view of, multiple lenses tend to lead to a better investment decision, from our perspective. And so it's similar to what the guys have been talking about, having individuals with subject matter expertise or skill sets on a particular item. And what we try to do is if we go to another market like Brazil, we try to bring that expertise there. We marry that up with the local members that we have in that market, and we think that also leads to continuity in underwriting.
Okay, thank you. Brent, from a competitive perspective, do you think that there's a home court advantage for Canadian PE firms in Canada, whether if you look at it in terms of financing, or is there any sort of favored nations from the sellers to Canadian PE firms? Do you think there's an actual difference?
Yeah, we built our whole business based on that strategy, and it's almost our singular focus. So, I agree with everyone at this table that there are lots of opportunities around the world where there's a shortage of capital. But there's a lot of large American firms that have tried to gain footholds in capital by giving guys a suitcase and giving them an office here somewhere and saying, win some market share. And there's lots of young startup private equity funds starting all the time in Canada as well. But these relationships take a very, very long time to build. Having done this for 30 years in this marketplace, you build a brand, the brand attracts interest, the number of people you've done transactions with before consistently bring you your next transaction each time. If I look at the number of transactions that we've done that are in our most recent fund that were touched by someone in a prior fund, it's a very large percentage of what we do. In addition, the Canadian banks are best friends to all of us. They are so supportive of all of us. They give us lots of room. They give us commitments way bigger than we're willing to take on most of the transactions we do. And their covenant patterns and everything are extremely friendly to all of us. And in addition, they bring us relationships, and they bring us people that we've done business with because they've done business with. They have huge networks of people out trying to find the next opportunity, and they bring them to us and to people like us, to everyone on this table. So, it's way easier for us to do a transaction in our home market than it is for us to do one in others. And we think it's way tougher for U.S. funds to come into this marketplace and compete with us. For sure, if a U.S. agent has a book and he shows it to everyone, the business ends up becoming, the sale process ends up becoming commoditized, and in most cases we don't even participate. But there's enough stuff available to people like us in this marketplace, really based on relationships that have been built over the last 30 or 40 years, and I think we have a real advantage in that. I mean, it's proven that most of our book comes from opportunities that look like that. It doesn't mean it's the only strategy, but it works for us.
Okay, thanks, Brent. I think that was well said. I'll address this next question to both Seth and Dave. As multi-asset global investors, where would you increase your exposure today when you think about whether sector, geography, or asset class? I know healthcare was one that was mentioned, and maybe Seth, I'll start with you.
Sure. It's also not a question that I spend a ton of time thinking of, but I kind of put myself in Dave's camp. We try mostly to look for opportunities where we think we have an edge of some sort. And that's as important to us as a sectorial outlook or anything else. Having said all that, we've always been extraordinarily fond of the United States, despite all its misgivings at the moment. It's got a few. It's still a fantastic place to invest. It's got a vibrant, changing economy, and a strict adherence to rule of law, which we love. As to type of investment, I'm a private equity guy. I'm an optimist by nature, and so I've always loved equities. And if you're going to be in equities, I love private equity because we have control, and control gives you levers to make change. I think it's really that simple. So love the private equity industry, love the developed economies in the States. If I were to pick an exciting sector, maybe, I think software replacing other forms of business services is really neat. If you can find something that's reasonably priced, that's a little bit more challenging. So things have to come together. Edge, price, outlook all have to come together, and that's usually more episodic than predictable.
Okay. Dave?
Yeah, so we're spending some time in the technology space, and when I say spending some time, this is going to take years for us to develop whether we actually would have an advantage in that space, but it's hard to ignore the increasing trends of technology in the investable opportunity set. In terms of markets, we're trying to figure China out. I agree with Seth on the U.S. that if you think about our focus the next 10 years, we view the U.S. as primarily where we'll do a lot of our investing, but you can't ignore China. And when we look at new markets, we generally do a three-part test. You've got to have rule of law, respect for capital markets, and the third one is it's got to be scalable. So Vietnam would, for us, check the first two, but not necessarily scalable. China is an incredibly large market that you just can't ignore over the next 25 years. But these things, you don't want to go in a big way. For us, it tends to take about 10, 15 years to get conviction before we'll put money to work in that market.
Okay, thank you. And maybe John, a similar question, maybe a bit more general, but where do you see the most opportunity for you in the future?
So I think, again, it's more a capital markets view in the sense that, we've been observing for a long period of time that more and more public investors are choosing passive strategies. And so it's tending to have an increasing disconnect between companies that are in the index, whatever that index may be, and companies that aren't. And so, coming back to a mid-market Canadian perspective, that leaves a lot of companies stranded, either stranded as public companies that have no following, and their prices have really disconnected from maybe underlying value, but also companies that would have historically chosen to find liquidity through an IPO. When we look back, in Canada, for the income trust market was a phenomenal market in terms of capital raising. That market hasn't existed for a number of years, and so the opportunity for private equity is to fill those voids, fill that void that has traditionally been taken by the public market, and our investors see it. Our investors have gone to a barbell approach. They've got passive strategies on the public side, and they're paying fees to people like us who are active investors, active owners, control positions, make decisions, and hopefully make the underlying companies better. So As I said, from an opportunity point of view, we focus a lot on public markets, and that could be taking a mid-cap company private, or it could be buying a division from a public company because they're trying to figure out how to move themselves forward.
Okay, good. Thank you, John. Okay, we're getting close to the end of the session, and I'm going to ask each of you as a last question for some predictions for the future. And just to give you an example, Rob Kavik, who's one of our economists at BMO, has a few good, what I'll call out there predictions for the future, which I'll share with you. And remember, this is Rob's, not BMO's, and not mine. His first prediction, the Leafs are going to win the Stanley Cup in 2020. Trump is going to win by a larger margin than in 2016. And the longest expansion ever is going to run even longer. So, with those examples, I'm going to direct the same question to each of you to provide us a prediction for 2020, and it can be anything, whether it's about politics, sports, economics, technology, whatever you like. So maybe I'll start with, I'll go from Pascal.
I'm sorry to contradict your guy, but the Canadians will win for sure. That's the one thing. Second, I think we still have a good 8 to 10 months run in the economy right now. Maybe Trump will win again, but it's going to create turmoil, I think, coming next August, September, in the economy, in the U.S. economy, and most likely in Canada as well. So if we try to time our exits and new transactions, I think we have a good 8 to 10 months ahead of us to execute them. Then it's going to be a turmoil for probably 6 to 8 months. That's my prediction.
John?
Well, I'm going to stick to maybe hope as opposed to prediction. And I was saying to Dave, I was at a dinner last week where Ken Dryden was speaking, and someone asked him the question about who's going to win the Stanley Cup. And he said there's 10 teams that are all pretty close. And he said, the Leafs are going to be inspired by the Raptors' success last year, and they have now the need to win, not just the hope to win. So I'm gonna take your guys' first prediction of the Leafs winning the cup.
All right. Brent?
So his prediction for that probably falls on this, probably is as unlikely as their performance over the last month. But I don't know. I think we should. We're all Canadians. We all live in this room. We should look at what happened in the last month. It's interesting. We all watch CNN, MSNBC, and Fox more than we watch the CBC these days. Our election was pretty boring to all of us. Nobody got very inspired over the last little while. But if any of them are able to raise some money, we'll see another election in the next 18 months. And what will happen, I'm not positive, but this country is ready for change as well, I think.
Okay. Dave?
Look, I think John's got to declare his bias as a former Leaf director, and as a 50-year-old, I've never seen them win in my lifetime, so I'm not as optimistic. But I will say the 2020 Super Bowl champion Buffalo Bills.
Okay. That is out there.
There we go.
It is out there, but it's real.
There we go.
Seth?
Well, the only thing that topped that, I'll go with Nets, Jets, and Mets all being league championships. And then on the technology front, I think high voltage batteries for propulsion are, whether or not it'll be 2020 or 2021 or 2022, I think they're coming. I think there is a tremendous amount of investment in the technology all over the world. I don't think, by the way, Tesla's necessarily or even likely to be the big winner from electrification of drivetrains. I think that honor will more likely go to somebody like BMW, Volkswagen, or Mercedes. But I think it's coming, and it's going to take a while. But when we get high voltage batteries to the point where they can be charged rapidly and have adequate range to make most drivers comfortable, I think they're going to be a force to be reckoned with and extraordinarily disruptive to what is now a OEM supply chain that is obviously driven off internal combustion engines.
Okay, thank you. All right, I promised that we'd have some time for Q&A. We've got about 3 minutes left, and I was told I could take an extra 5, so we've got somewhere between 3 and 8 minutes for some Q&A. So, any questions in the audience?
Bored him to death.
Go ahead.
Shout it out.
Maybe indirectly talked about this a bit, but how do you think about climate change? Have you looked at your existing portfolios to do any analysis about how climate change might have impacted them already, and how will that influence, whether positively or negatively, future investment decisions?
I'll repeat the question just in case everybody didn't hear it, is about climate change and how is the thought of climate change and what it's doing impacting how we're managing existing portfolio companies and thinking about investing in future portfolio companies. Is that good? Okay. Open to anybody who wants to answer.
Well, I think most of us in the business of raising money from institutional investors are focused very much on ensuring that we have solid ESG standards through our review process, and that's certainly the case at Onyx as well. While I wouldn't say that we focus specifically on climate change, we spend a great deal of time focusing on elements of production that get to the same place, i.e. waste and scrap. A business that's putting a lot of effluent out, or a business that's loading up local landfills is not being run well today. And so we focus more on, when we're looking at a business, we're focusing more on what it's doing or not doing to make the situation worse or better.
Anybody else want to add to that?
I actually, what's interesting in Toronto is there's a big incubator of the AI community, and there was a young group of guys who came in on Friday to speak to us about using data analytics and AI to predict climate change impacts on private equity. And it was like much smarter and complicated than I could ever pretend to understand it. But if you take at face value, what they were saying is the ability to look back at historical, I'll give you an example, historical hydrology. And so what does that mean with climate change impacts that they feel very factual? And what does it mean to, if you own a hydroelectric plant, and what your future hydrology would be, and therefore your NAV today of that asset? I tried to make it a little more applicable to what we do, and they claim that with being able to use data and AI to be able to predict power costs. Well, for each of us in a lot of our businesses, power and labor tend to be two of the most significant input costs. So I want to learn more about it. As I said, I'm not sure that I really follow it, but I think there's real opportunity for people to extract climate change inferences to lead to better inputs in our models.
Yeah, I mean, we spend a lot of time on the topic, a lot of time. In fact, our most recent acquisition is a bottler and a bottler in plastic bottles. So probably $1 million of due diligence on trends in that space. We do a lot of chemical deals, so because we do chemical deals, the environmental issues are the most important issues in the analysis of the transaction. So $1 million or $2 million at the beginning of every one of those. We start every single one of our meetings in every one of our board meetings, in every one of our companies on climate issues and environmental issues, and a lot of in addition to workplace safety and all the other ESG issues that Seth talked about earlier. You know, diversity is a big issue for all of us who are raising money, and look around this room. You know, we don't have a very good gender balance in here either, and it is a terrible part of our industry, and one we should all be embarrassed about. The fact that there's 5 of us sitting up here and they're all males is a really bad thing, a really bad thing, and we should all be cognizant of it and make the necessary changes in our organization. They're very difficult for us all to do. We're all focused on it. I know if I sit around here, there's not one of us that isn't focused on those issues, but we've done a bad job as an industry, a really bad job, and we all make too much money, and we all have to invest in diversity issues.
Okay, thank you. I think we have time for one more question. Do we have a question out there? Anybody? Okay. Oh, we got one.
Hi, thanks very much. I'm a little bit of fish out of the water here. I'm a family doc from London, but interested in virtualization of healthcare. So I do some work with Teledoc Consulting, have a foot in with OTN doing telemedicine, and just wondering where you see that going and what sort of opportunities there might be.
Wow, I'm not sure who to direct that one to.
Well, you know, I chair a hospital board, so I watch the influence of those things, and I don't normally give political pitches, but and I'm sure this won't be a popular one, but this government, not because it's been led by this government, but by the bureaucrats who run our healthcare system, are very, very focused on vertically integrating healthcare down to the home. And what you're talking about is going to become an ever increasingly important part of what happens. I know that they went backwards on funding the telemedicine stuff. They've now reversed that position because they knew they were wrong on that specific issue. But there are unbelievable financial pressures on the system, and the only way they're going to get relieved is by moving healthcare out of the hospitals and back to the home, moving them away from those big buildings on University Avenue or in London at the London Health Centre, and moving them back into the homes. And as a result, things like personal care and telemedicine are going to be increasingly important, not less important.
I think particularly in the management of chronic conditions, there's, I think, from several different directions, there's efforts underway to get people to simply follow their pharmaceutical regimen, which is a huge issue in healthcare today. We can do all we want about providing cures if people don't follow the advice, and for most of the people in this room, that probably seems outlandish that people aren't doing what they're supposed to do. But it's actually a huge issue in the management of chronic care. And I think technology, not hugely sophisticated technology, just apps that help get people to do what they're supposed to do, can have a profound impact on the cost of healthcare.
And part of the focus in our healthcare investment, what we're doing is to just pick up on some of the ones that are the more logical things to do at the front of that. So I've got 2 parents with Alzheimer's. Getting them in and out of their assisted living home just takes them completely out of sorts and makes it more difficult. If you could actually keep people in a familiar environment and use some of that front-facing healthcare, those are just real logical places for us to start.
Okay, thank you for that question. Very good. Okay, that brings us to the end of the session. I think this is a great way to start the day. I want to thank our panelists for joining us today and taking time out of what I know are very, very busy schedules. So it is greatly appreciated. Your insights were transparent, they were informative, and most of all, they were appreciated. So thank you very much.
Let's hear it one more time for Brent, David, Seth, John, Pascal, and Nadeem. That was truly lived up to the hype. Titans of the industry. One more time for these gentlemen. The Avengers Infinity War of plenary panels. Really, ladies and gentlemen. How lucky were we to kick that off. And before you get going, we're moving right into our second main plenary panel of the morning. So if you want to stretch, get a coffee, you can do that. But we're starting right away, just so you know. We're starting right now. And I'm going to ask you a quick question as you mix and mingle, because I like to make sure that you're paying attention. Who can tell me what all 5 of those senior executives in this industry, when did they say the recession would happen? When did they say it would happen?
10 months. 10 months.
The correct answer, you guessed 10 months, sir. The correct answer was, the consensus was 8 to 10. It's kind of happening. That was the consensus, but a good guess. Now, you are here for our second plenary panel, and we're going to get right into it. Such a jam-packed schedule today. We want to move right into it. So this is our panel, Disruption in the Technology Sector. And just a reminder, you can use technology to ask our panelists any questions you might have at ACG_Toronto. A huge thanks to RSM Canada for sponsoring this panel. Our panelists are, if they're ready to join us, Elaine Kunda from Disruption Ventures. Hi, Elaine. Lisa Melchior from Virtue Capital. Rich Osborne from TELUS Ventures. Hi. Eugene Roman from Design AI Limited. And it's all being moderated by Amar Joshi from RSM Canada. So please grab your seats and help me welcome them to the stage.
How are you? Okay. Thank you.
You're welcome. I used to work for Bell.
Okay.
Hi,
Elaine. Nice to meet you.
Rich. Eugene.
And so
We sat the right way, right?
with like
We sat in the right order.
standards.
Yeah, that's all right. You got an interesting portfolio. That's good. We should
This is really cute.
I am, yeah, I'm
we should connect sometime. I work on Wall
I
Street.
know Hex.
Okay.
Because I retired from Canadian Tire Christmas.
Yeah, it's really tough.
Okay.
And I don't like it.
You're actually based in New York?
Like I can get away with some other.
Hi, good morning. I'm working here in the parking lot. We have a car in black color, BMW, with Bravo Yankee Zulu Metro, number 289, is still on.
Took my son down to Wall Street. He's like 13.
Nobody?
It's a small, it's very tight down there.
Yeah, it's amazing.
Old. Yeah. I hang at 48. Something down there called Work
Thanks.
Work Fusion. We'll
And
take
your
over. They'll
sweet
do
spot
the
will
SAP
be-
of the AI space, and I'm an advisor to that. Based out of Belarus. So we'll talk.
Right, good morning, everyone.
They're the movers.
Thanks for attending today's session, Disruption in the Technology Sector. We have a great panel here. I think we're going to get some really unique and different perspectives on what disruption in technology means. So, to get started, we can go through the panel. Maybe each of you can provide a quick summary of yourself, your firm, and how you're involved in disruption.
Hi, my name is Elaine Kunda. I'm the founder of Disruption Ventures. Disruption Ventures is an early stage venture fund that's investing in female-founded companies.
Hi, I'm Lisa Melchior, and I'm the founder of Virtue Capital. And Virtue is providing late-stage growth to a mid-market buyout for what we see as an underserved technology market in Canada.
I'm Rich Osborne. I'm with TELUS Ventures. TELUS, for those of you who don't know, is one of the major telcos in Canada, and unlike our competitors, Bell and Rogers, who have focused on media, we've focused and diversified away from our core business in areas like digital health. We're the largest digital health company in Canada, smart cities, ag tech, and we have a subsidiary called TELUS International, which operates in 12 countries doing BPO and ITO with a partner, Barings Private Equity, as a minority partner. And I lead our innovation and investment team supporting all lines of business at TELUS.
Hi, I'm Eugene Roman. I retired from 38 years in technology in this country called Canada. And since then, I've been a gig worker. I run a firm called Design AI Limited. What our mission is to change the world for the AI space, and I spent a lot of time in Europe on that. The Europeans really are driving the intelligent agenda space, and I think they've got a leg up on most parts of the world, and we'll see what comes.
Fantastic. And my name is Amar Joshi. I lead RSM Canada's management consulting practice with a real focus on technology and digital transformation, and I'm going to be the moderator for today. So, that being said, this panel is about disruption and company disruption. So let's start with you, Elaine, and get your perspective on what opportunities do you see to invest in female entrepreneurs in the technology industry?
So I think Brent suggested on the last panel that the industry hasn't done a great job investing in women-founded companies and particularly investing in women fund managers. So this is a gap. This is an opportunity. The research all indicates that women are a good investment, but they're just not attracting the dollars that they need to scale and be successful in their business. So I saw this gap. I saw this opportunity. Saw a lot of incredible women who were struggling to raise money and therefore struggled to grow their business at the rate that they should be. Might have been market leaders at the time and saw competition come into the market before they had a chance to scale and grow. And so from my perspective, I saw this as a great investment opportunity, and at the same time, I get to help to make change in the industry, which is really important.
Yeah, some great points there. And, what does that say about capital raising today?
Yeah, I mean, the challenge is there's a couple of things. So we have something called unconscious bias. And the first thing that I get when I walk in a room to raise money is people saying, but we don't care who's on the other side of the table, as long as you have a good business thesis, we just want to make money. And the reason it's called unconscious bias is we're just not aware of our biases. And if you look around the room and you look how many men are in here, there's something fundamental that's keeping women out of away from the table. And there's two options. Either there's a fundamental problem, or you just don't believe that women are capable or smart enough to be at the table. And I don't think anyone in this room thinks that. So, with any sort of change, it takes a lot of work and it takes a lot of changing opinions and beliefs. My lead investor is Scotiabank, and they've been great in recognizing that not only is there a problem, but they want to be part of the solution, which has been a tremendous leap of faith.
Yeah, some great points there, and it really kind of shows how underutilized women are in this segment of the market.
Yeah, we have this, we're a country of 36 million people, and we're trying to compete globally. And right now we're investing in 50% of our population. And we're missing out on opportunities that women solve different problems quite regularly. And so you've got investment professionals sitting on the other side of the table who may not relate. They may not understand the problems that they're solving. And so what are we missing out on because we don't have more women there investing and putting dollars to work?
Awesome. So Lisa, let's pivot to you a little bit and let's talk about why you started Virtue.
Well, it's an interesting story because I left a private equity career where I was in very large institutions, investing in the mid to high end of the buyout space, spending a lot of my time in the U.S. market where there's a tremendous amount of competition for mid to large buyout capital, even in my area of focus, which is technology investing. And when I left and decided to do something on my own and stay closer to home, I was really surprised to find that in Canada, there was really little option for growing tech companies in terms of locally based PE investors. And that, in the face of what I've seen as a proliferation in really successful venture funds that are supporting the growth of technology companies in this country. I think we have over 60 active venture capital firms here today, and they're spawning some really, really exciting companies. And so that gap in terms of where do they get financed next, where do they
get their last stage of growth equity, or if they're ready for buyout, who invests in them. That gap has been filled over the past several years by a lot of U.S. competitors, some of which may be in the room. And it's because we have some really attractive assets up here. And I thought it was talked about a little bit in the last panel how being local matters in Canada. Relationships really matter. It's a pretty small community, and your brand and your reputation can take you far away here. And so my hypothesis was if you had a globally competitive firm that was focused on this industry based here, that would be a competitive advantage. And so that was the genesis of it. 2.5 years in, I'd say it's proven out in my mind. We've made a couple of investments and have a ton in the pipeline, and so growing the team. So that was the reason why, and I'm very excited about the future opportunity too.
Fantastic. And I know you touched on some of the differences between the Canadian and U.S. market. We all know there are differences. Maybe you can kind of delve into that a little bit more.
In terms of the capital market itself, for any one of the investments that I would have been bidding on in my former role, there could have been 24 highly qualified PE firms competing for it. So it's just the depth of the market in the U.S. is incredible, both in terms of companies and opportunities, but even it feels more so sometimes in terms of capital availability. So, that is, to me, the starkest difference in our markets. I think Canada is a really interesting place for technology right now. We've got some excellent pockets of innovation where we can punch above our weight. We've got an economy that, frankly, I think needs to be transformed from a resource and manufacturing-based economy. And the ecosystem to support those companies needs to be developed, and there's a long way to go, and I think we're at the really beginning stages of that.
Fantastic. I think you provide some really good nuances of the Canadian market. Rich, let's talk a little bit about yourself and TELUS Ventures. You oversee a large portfolio of technology investments, including digital health, data security, Internet of Things. How do you choose what to focus on?
Yeah, so I think one of the perspectives that maybe I bring is, as a corporate investor, we play a lot of different roles in the ecosystem. Obviously, we're customers, we're LPs oftentimes, we're acquirers. There's very few corporate venture funds in Canada that are actively investing. So not surprisingly, we have a strategic element to what we do. So we look for things that, call it, where we can play defense, protect our core business a little bit. So we're preparing for things like 5G. We're investing in things like improving the customer experience. I know most people think telcos are great at it already, but we like to think we can improve a little bit. And then, as you mentioned, some of those real growth areas for us, like digital health, we believe is actually a market that we can, or a sector that we can actually leverage what we've built, which is the largest ecosystem in Canada, where we have visibility on kind of 2/3 market share in the primary care and the pharmacy management and claims adjudication, and then moving into consumer health. So some of the questions around telehealth, we can bring that internationally now to bring it to some other ecosystems. So where we focus is where TELUS can leverage its strengths as a telco, which is kind of communications, security, privacy, identity, et cetera, bring it into new verticals. So again, digital health is one. We're very bullish on smart cities. We're very bullish on ag tech. And our TELUS International business, which is now about $1.5 billion business, we think there's a lot of runway in that business around the world. We're in 10 countries on that business. You'll see that double both top line and geography.
Great. And you touched on the ecosystem here a little bit. I'd love to kind of get your perspective on the growth of the Canadian technology ecosystem over the past 5 years.
Yeah, I mean, look, I think everybody would agree, it's both broader and deeper. I mean, God, we had a $500 million financing out of Newfoundland like 2 weeks ago, right? I mean, it's a robust market. I think I won a bet with the RBC guys. There's 17 over $100 million venture financings in the last year and a half. I mean, that's a big number. So you're certainly seeing the larger financings. You're seeing a lot more seed, just on a dollar and absolute basis, number of deals in dollars going into seed. A little bit of drop off in A and B in the last year or two, and a lot more later stage growth. So I think it's healthy. I would say two things. Number one, back to my earlier point, I wonder where the corporates are from a direct investment. I think, there's us, there's RBC, there's really Intact Insurance. There's not that many. They're playing different roles, but I think that's a real sort of area where I'd like to see more activity. And then the other thing is, it's still, and I think the panel would agree, it's still a pretty thin management marketplace. So we're getting now the exits, we're getting the founders who've built a company who are coming back and doing it again. I would say just, not to slag the Canadian psyche too much, I am Canadian, but there is a tendency more so than I've seen in other markets for the Canadian who is successful as an entrepreneur who sells his business to go be a venture capitalist or, kind of to retire. They're not predisposed, for the most part, gross generalization, but to go and do it again. Whereas in the Valley, it's kind of automatic that you're going to go do 2, 3, 4. So I'd love to see more of that. And that mid-level talent that scales a business kind of from 10 to 150 million revenue, still very, very thin in Canada.
This one's coming to me. I can feel it coming.
Really? We're going to start back here. No, it's coming to you, Eugene. Thanks, Rich. I think you provided some really good context in terms of the evolution of the Canadian marketplace. Eugene, given your wide set of experiences across different industries, including...
That's a nice way of saying I'm old, but I am old, so older.
I scratched that out of my notes, but absolutely. I think, as you're in your current role as professor of design expertise at McMaster, how do traditional non-technology companies compete if the statement, software is eating the world, is actually true?
Well, I could show you a picture of me dressed up in a full surgical setup. I was sprayed by hydrogen peroxide. It's a major pork producer. And the question they put to me in Europe was, how do we run our business better digitally? And so that is a prime example of old industries that are hustling. I don't want you to focus on that term, to hustle into the future. He described people who cash out and go to the cottage. We have nice cottages here. I'm 62, I semi-retired. People are now dropping the retired part, you're semi-something. I'm a gig worker. I've done 6 gigs. I retired December 31st. Next thing, I was on a plane to Davos to talk about Tech Nation. Tech nations out there, and I can name a few, are changing the world. Canada, I'm very upset with our government policies. I don't care what level of government. We talk innovation and don't do a heck of a lot about it. If you were at a recent AI conference, they said, lots of research, not much action. We got to change that. That's part of my mission giving back in the latter part of my career. I teach intelligent automation. Intelligent automation is a game changer. I can name company after company after company that I've worked with. I worked with 6 so far this year who are changing the industries they're in. I come from Nortel B&R. I just came from Ottawa. It pissed me off to see all those great buildings where we did R&D. They're all government buildings now. Troublesome, okay? If you read Innovation Games by John Tyson, if you haven't read it, read it. We have to change that in Canada, or else we're just going to be a nice, happy, grain economy, resource economy, and there's nothing wrong with that if that's what you want. But the real action is brains and grains, and Canada has to get it. And I'll tell you right now, the only reason I came down here is you guys are capitalists. Is that the right term? Whatever the term is. We've got to get it. And I think his point about hustle, we need more hustle. I did a seminar to university students on Saturday, and I used 3 words, humble, hungry, and hustle. And there's a book. We need to add the hustle. We're humble and hungry in Canada. Okay to be humble, and yeah, okay, fine. But where's the hustle? I mean, and you see people here, we do have it, just not enough of it. And, when I retired from Canadian Tire, I was head of technology, Canadian Tire has done great in use of advanced technology. I'm very pleased where it has gone to. They stopped me from retiring in 2012. Now, a few other companies have stopped me from retiring. Maybe I eventually will expire, but not retire. Remember that. But the point is, my staff said to me, "You're never going to retire." No, we're just going to keep doing useful things. And innovation, by the way, ask yourself, is putting great ideas to work. I'm working with 2 Canadian companies right now. I prefer not to give you their names. They're going to moneyball like crazy. I spent time with Ring. It sold for $1 billion. Grammarly just valued at $1 billion. They're my friend. They're mentoring me on how to hustle. So let's get with it, Canada. And we have to change the playing field. I'll give you a simple example. Ukraine. It's in the news a lot, right? Every ministry has to have a deputy minister digital, the new government. The deputy prime minister responsible for digital. Hello, Justin Trudeau, sorry, wrong prime minister. Hello, Justin, where are you? We've got to digitize this country. E-health, look at what TELUS has done. I commend them for tremendous work. And it's not in Canada, it's in the global village. They're going global, and that's the only way we're going to do it. Nortel, we went global. It didn't survive. So enough of that, but you see the point. Hustle. We should have it on every time it says innovation, dash hustle. And then the young people who do startups and upstarts and companies that are here, there's some tremendous companies in this country, hustle it. I went to Waterloo, I come from Waterloo, I went back to Waterloo. There's hustle happening, but there's also the Americans coming in with their big battleships. Google's there sopping up resources. I understand how that works. I want a Canadian Google. I want a Canadian Grammarly. I want a Canadian Angry Birds. And I don't want to see another BlackBerry, and these things happen. They invented the damn technology, and the technology ate them. We talk about software eating, and the technology eats you. Enough for that topic. How do I feel? Good. I'm relaxed now. Just warming up.
That was fantastic. That was passionate, and I think everyone here is going to remember hustle. That was great. Rich, let's pivot back to you. Can you talk about the rise of corporate venture investors and your experience with that?
Yeah, I mean, I think I talked to my last answer, but I think the number is about 3,000 global corporate venture groups now. You know, from the Fortune 1000, I think 90% of the Fortune 1000 has an arm. And you know, the most active ones, guess what? It's not Google, it's not Intel. I mean, they're up there, but it's Alibaba, it's Tencent, it's Baidu. So you certainly see how they're viewing innovation, you know, disrupting themselves to the theme of the panel. You know, I had the opportunity about a year ago to spend some time with Alibaba, and you know, somebody was talking about Amazon on the last panel. I mean, Alibaba could be Amazon's Amazon. I mean, there's a legitimate chance. So you kind of look at that and you say, if those organizations that are so on the forefront are investing in the next generation of startups and technology, well, then it's only logical that the more legacy incumbent type companies would be doing that. And so to me, it's a no-brainer. It's not the panacea. I think it's a tool in the toolkit. You know, I mentioned the dearth of corporate venture in Canada. I don't know why that is. I really, truly don't. I think it's a good question to be answered. Maybe some folks in the room have views. I will say this, though. You know, if the rise of the share of regular venture capital continues to climb, corporate VC will be over 50% in the next 2 to 3 years. So corporate VCs will invest more than call them financial sponsors. So that's a pretty meaningful impact. And you know, I think the last thing I'll say is, I think if you go back 10 or 15 years, most of the individuals who are running corporate VCs were people who had come out of, say, finance or an operating line of the business. There's been a whole professionalization of that asset class or of that group. So I think, you know, entrepreneurs used to have to kind of deal with people that really didn't understand startups, really didn't understand venture, and I think that's totally changed. So the way we measure ourselves is on a financial basis. First and foremost, we're trying to find the best entrepreneurs, you know, with the best ideas, targeting the biggest opportunities, and then figure out a way to argue internally that they're relevant to TELUS. We're going to place about $150 million in capital this year, and our view is those will be the best deals, you know, that were available globally we're in Israel, we're in China, we're in Singapore, we're in South America, we're in London. And so we're trying to just kind of spread our collective wings and in-source that innovation.
Fantastic. Let's talk a little bit about some of the, I know you touched on kind of the VC side of it. Let's talk about technology. And what are some of those emerging technologies that perhaps don't get as much attention as, AI, blockchain, Internet of Things? Yeah.
Yeah, I think if you're a venture guy, you have to say AI and blockchain on every panel. It's like part of the,
There you go.
So I said it. I'd highlight two, maybe three. So one would be machine vision. I think the ability to recognize all sorts of images and then apply, whether it's ML or sort of, processing capacity to do some sort of action on that image is just increasing exponentially. I think 5G is, obviously as a telco guy, I believe this, but I do think it is going to change the world when you get 10 to 100 times the speed with, a tenth the latency. It's going to blow people's minds. But I think the one I would say, and it's pretty esoteric and a bit out there, and everybody's kind of tired of hearing about it maybe, but is quantum computing. So if you've read, Google just announced the capacity with a 52-qubit computer to solve a problem that takes a regular supercomputer 10,000 years, or would have taken a regular supercomputer 10,000 years. They did it in 200 seconds. So that's about 1 trillion times faster. I mean, it's almost incomprehensible. So you think, well, they're solving these really nerdy math problems, who gives a shit? The truth is, if those things work, and it won't be in 2 years, but it'll sure be before 20, if those things work, every security system globally is irrelevant and outdated. And now you've got a problem. And so to me, that harnessing that in the short to midterm is going to be incredibly exciting.
Interesting. I know in your previous responses you touched a little bit on healthcare, or health tech. Let's kind of delve deeper into that if you want to provide your perspective.
On health?
Yeah.
Yeah, so we have a big digital health business. Again, I'm taking it global. The opportunity is twofold in my mind. One, the alignment of payment and incentives is changing for the better in most countries around the world, slowly but sure. The arc is bending in the right way, which is creating all the innovation and value capture activities that you expect it would. In Canada and in the US and elsewhere, employers are playing a much more active role. We heard the stat earlier, $500 million in harnessing technology for the benefit of their employees, not only to save costs, but as a competitive advantage going forward in the war on talent. So that's one. The other is just the role of genomic medicine, right? When you can deliver the right drug to the right person at the right time, you can save lives, obviously that's good, but you can actually ameliorate what's a fundamental stat. About 50% of the drugs that people take don't work for them, or actually kill them, or make them significantly worse. And in this day and age, when you've got the capacity to fix that with really simple tests, why wouldn't you? And so you've got to work out all the value chain and all the incentives, as I say, but as those two technologies propagate out, both with the payer models and the ecosystems, again, our bet is that's a pretty exciting place to be.
Fantastic, thanks for that. Lisa, let's bring back to you as well. And hand in hand with some of the things Rich touched on, have we reached peak valuations for software companies in your perspective?
Well, it certainly feels like there had been a lot of irrational exuberance on the part of some of the big B2C plays, especially. Very recently, I've noted in the market that many processes are taking a little longer. Some of them are breaking. So I think we're seeing the tipping or the maybe correction on valuation for some of the really, really white-hot sectors, which I think is healthy. I'd look back to the late 90s when I started my career, and dot-coms were equally irrationally, exuberantly priced. And there was a massive bubble burst, as we all know, on .com. And it's not that those businesses were doing they had the right idea. The future was there. It's just that investors had grossly underestimated how long it would take. And I think it's a similar, we often see that pattern play out again, and maybe, in some of the more popular names now that are very much in the front page of the paper. But for the most part, if you look at the technology and the companies that are being built, there's some really great, long-standing potential companies out there.
Yeah, good point. And let's kind of delve into that a little bit more. So, what message do you take away from some of the disappointing post-IPO performance of companies like Uber and Slack?
Yeah, I mean, be a smart investor. That's, I don't think they're bad companies. I just think that, and you could add a few more names to that list, that people were, investors had provided capital and mispriced the financings, and they just took on way too much money. And look, my background is as a PE investor, not a VC, and so PE investors are kind of very laser focused on cash flow, and if the company's not cash flowing now, when it will, and are they being smart capital allocators? Do they price capital properly as a company? And I'd say for the most part, companies that are correcting now would probably not pass many of those tests.
So, one more question for you here.
Yeah.
Is user growth and revenue growth sufficient to maintain high valuations, or do you see profitability as becoming more of a factor?
Growth is inherent in the business that I think we're all in up here. Growth is critical. Now, whether the companies are profitable now or later, in my mind, when I'm investing in a company, they have to be able to prove to me that they know when that could happen. If there's lack of discipline around managing your cash flow, then I think that could lead to trouble. But you have to invest in growth too. And I agree with Eugene. Like, we need to hustle and invest in growth and not be afraid to do that. We just have to be smart about it. And so it's not a yes or no answer.
Yeah, absolutely. I like the way you use hustle in there, right?
Yeah.
So Elaine, let's bring it back to you now. Let's talk about talent. And how would you characterize the pipeline of female talent in engineering, commerce, law, and business schools?
So we're very low in women engineers. In STEM, we have a significant number of women in life sciences. Medicine, I think more women than men now graduate from medicine. What that's led to in the venture world, in entrepreneurship and startup, is there's a tremendous number of women who are starting health tech companies, and there aren't a lot of people investing in health tech. I think the slow adoption rates definitely have been impacted venture interest, the lack of patience for how long it might take. So we have a talent pool, but I think what's changed in the last few years, it used to be that you had to be a computer science major graduate to start a tech company, but that no longer is the requirement. So you have women who are able to leverage technology that's already been developed and use it as a category killer rather than creating new technology. And so what they are is disrupting industries, finding opportunities to be more efficient and to innovate, and not necessarily have that technical background.
Now, are female entrepreneurs funding you, or are you funding them?
Yeah. So it's funny, I read my offering memorandum yesterday, and I had my thesis lined out, and I wanted to see how I've fared in comparison to what I thought. And one of my beliefs was that there would be a network effect with what I'm doing, and that the best and brightest female founders would find me. And that I would say is absolutely true. I'm getting opportunities that I wouldn't otherwise get, which is fantastic. I'm attending an event with Goldman Sachs, which is a small round table of I think 15 or 20 people on Wednesday around healthcare and consumer healthcare. And I'm getting a ton of exposure through US media. The reality is there's a lot of talk, there's a lot of discussion, there's a lot of intent in investing in women. There isn't a lot of capital being deployed still. And so that does, because I am deploying capital, it does give me an advantage for sure.
Fantastic. I think those are some really good and relevant insights into the female talent in the industries. Eugene, we'll bring it back to you. And one of the questions is, what do you see as the biggest opportunity for traditional companies as we kind of
the answer is obvious, but it's not. It's to be deep digital. Now, that is a non-trivial thing for most companies to do. If you look at companies like Canadian Tire, the board met in 2011, said we need to go deeper, and they went and got this persona, that being myself, and said, go. But that is not an easy step for companies to take. I commend them for doing it. 7 years later, we rocked and rolled for 7 years, and then I said, okay, I'm done. I want to go, before I leave this earth, go do some interesting things. And they said, fine. But I'm still an advisor. They've kept me linked, hard linked, and providing advice. I'm building a asymmetric growth model using various inputs that I picked up from my travels in the last 12 months, and I'm calling it Maximus, another term for Moneyball. And I've already unleashed it on a few companies, mid-stage companies. One's grown 20% already. Will now double. I like that number, double. It's a Canadian company. When I was at Nortel, it grew 19 times in my 20 years there. Run the numbers. We started $1 billion. By the time I moved on, $19 billion. I predicted the demise of Nortel, unfortunately, because I could see the end, and I left. But asymmetric growth is not something that we teach. You go to any school, I don't care if it's engineering, science, business. Okay, let me see a course on asymmetric growth, on thinking about how to do upscaling. It doesn't happen here. It doesn't happen in most universities, but some places are teaching it. The Scandinavian companies, I'm doing work in Helsinki, surprise, surprise. Like I'm getting calls from very strange places. My next stop is Helsinki. Let's talk about asymmetric growth using green industry. No plastic, all reusable paper to package products. That's what the Scandinavians are doing. So they see the world very differently. We in Canada have to stop following others. I can tell you right now, we're too prone to following trends, AI being a good example. We can change the world on intelligent automation, not AI. AI is out here. It's intelligent automation. Canadians have always been good at it. You look at BlackBerry, you look at TELUS, you look at Bell, you look at Rogers. We have the ingredients. Yet when you mix it up, we run into difficulties as a country. And the difficulty is, oh, well, is it an oil economy? Yes, for the next X years. I'm not arguing that. But look at Alberta. I used to work in Alberta. I mean, you know, tech failures are prevalent in Alberta. Why? Because they didn't get to scale. It wasn't that they don't have capable people. And, you know, the thing I run into, I deal a lot with universities, many universities. I run into this huge ego, oh, you know, we're the best. The best at what? You show me that you've birthed billion-dollar valuations. What's the next one? PetCube. Take a look. Smartphone for dogs. Hottest thing going. I work with the guys who came up with the idea for a smartphone for a dog. You'll pay anything to entertain your pet, trust you me. Okay? And that's the type of thinking. We have had it. I can show you. I showed slides on the weekend to students. What do these inventions have in common? Not one student could answer it. Next slide, please. Made in Canada. Everyone. We don't even know. So we better change the agenda. I commend those who are trying to change the agenda. This is an inventive country. The inventions then travel to the US because we chase capital. I got that part. But let's just keep inventing. Eventually, the capital stays home. Nortel was great in its time. B&R was great in its time. 90% of the internet runs on one chip developed in B&R, the OC192, still made in Ottawa, and nobody knows about it, right? Insulin down the street. Walk the list. So you can see I'm frustrated because I've got limited time left on this earth. And O Canada means a heck of a lot to me more than a national anthem in hockey. I've given up on hockey. I'm a Leaf fan. Sorry. Okay? We, the North, is a basketball nation, and that's a new world for us, and to continue. So you get my point. So we have to be passionate about this great country of ours. I've traveled this country, but I also see small-mindedness. We should be a country of the global village. We have multiple lingual capability, and we're tolerant, and we don't take that to our advantage. It hurts me because we have what it takes. Now, we have small population, large geography, and unfortunately, we have some ego going. Our universities need a good self-reflection on how to change the world, as opposed to, what are the marks of students they attract. It's one of the reasons I've taught at McMaster. I now actually have switched to York, that my resume shifted in the last year. I'm teaching at York, because York's shown humility, hunger, and hustle, and McMaster does as well. All right? Now, it's not an indictment on universities, but we've got to change how our educational system is preparing, and I'll say females, yeah, we've got an imbalance in the market, it's not good, but preparing students for this STEAM world. You know the term, right? Science, technology, engineering, art, and math. You look at what OCAD's done. So the Canadians can design for the future. Why? We have terrible weather. Any country that has terrible weather and a changing weather, we should learn from that. I've got a project underway under weather, I'll tell you, it would blow your minds, and that should be $1 billion valuation. I can't talk about it too much. My wife says I talk too much. But there are gems on weather. Canadians understand weather, number one. Look what's going on in California. OMG, terrible. Now, so weather is one thing that we should be weather experts. What else should we be experts at? Intelligent automation, we have proven time and time and time again that we can do this. Because we do have well-funded universities, we do have strong anchors to build on. Yet we don't build on it. I'm in the wine industry in Niagara. It's not a commercial. I got asked last week by one of the government auditors, where I get audited by 9 agencies, does any agency help you? I said no. The auditor was shaking his head. Not one. They just come to show up for taxes. 9 of them. That's great. And he saw a thriving business, we're growing, and we're globalizing, right? Last night's discussion was, how do we get this load to Japan? That was a chat in my family with my son who's running the business. He's going global. And it's not volume, it's high margin, high quality money balls. So if you haven't studied Moneyballs, I'm writing a book on it. How do you unlock the Moneyball? Canadian Tire, by the way, has a Moneyball team called X. We got the idea from Procter & Gamble in Cincinnati. X. What's that? Multiplier effect. So ask yourself, are there companies that can create multipliers? You call it the multiples. What about the multiplier effect? They're there. I've got 2 I'm working. I'll tell you who they are. You want? I mean, they're private companies. So one is Solus out of Ottawa. Data hubs, high-speed data hubs. Every stock exchange in the world uses it. What I'm trying to do is widen the lens a bit for them, and that's it. And they'll take off, because every company needs high-speed data exchange. The second company, Acedian out of Montreal, deep packet inspection of the highest order. 2 great companies. A lot of ex-Nortel guys, that's how I got connected to them. So 2 companies that are on a glide path to the future, made in Canada. I want 20. I only have 2 in my portfolio. The rest of my portfolio companies are elsewhere in the world. That's technology in Canada, and we better learn to hustle on it.
Thanks, Eugene. We're just wrapping up here. So one last question to all of you panelists. We've all heard of WeWork, right? Their meteoric rise, their sudden demise. I'd like each one of you to answer the following 2 questions. Is WeWork a technology company? And what is the lesson we learned from the WeWork story?
Lessons. I will say the first one is don't sell $750 million in stock as the CEO when you want to go public. That'd be a good first lesson. No, it's not a technology company. It's a real estate company, and it's a really great idea. It's just not a great business, and we need to remember that.
Yeah, no, it's absolutely not a technology company, and again, it goes back to this irrational exuberance point that I made. The fact that people could believe that it was is a reflection, I think, on the market. It's not a technology company, and so it should never have been financed as one or priced as one. And I agree with Elaine. It's a real estate company, and it's, I guess, an okay one. I don't know. I'm not a real estate investor.
Well, look, I mean, I met the guy once, and my view would be it couldn't have happened to a better guy. So if you have a kind of morally, ethically adrift, crappy business model, I don't know if it matters if it's tech or not.
It's probably the most nascent technology company known to mankind. It is a phygital company. We don't understand what it is, but that's beside the point. No more so when the iPhone came out in 2007. And the guys at Microsoft said, what's it good for? So notwithstanding the personality and the difficulties, real estate is digital. In a gig economy, this company, it will have to transform or somebody else will replace it. That's how economics works. But it is a phygital company. If you haven't studied physical digital effects, it is that. Hudson's Bay cannot use the space in their department stores because the department store era is over. The fact that these guys were going in and using the space in prime locations on the subway for gig workers like me to have a place to hang my hat and make economic sense of it and give me web services and give me healthcare. Look at the whole set of services. They're on the right path. Now, in every company like that, they do stupid things. So did Nortel. Now, I hope that they actually figure it out, but phygital effects is where I spend all my time. By the way, a fidget tail, that's what the TAIL company is called, Canadian Tire. If Canadian Tire didn't do the transformation that we did, bad things would happen because the Walmartians and the Home Depians, I keep going, right, are here, okay, and the Losians. So these people throw money at innovation like it's water, and people and Canadian companies have to sustain. But I think it's a fascinating case study in something new. When the Rogers family first launched radio, for 15 years in this city, nobody knew how to make money at it. And they thought they were crazy. Yeah, CFRB, anybody know what that stands for? Canada's first Rogers Broadcasting, 1010. Was stolen from the family when the father died. CFTR, the son had revenge. Canada's first had Rogers. These people in the Rogers family knew what they were doing. Radio, go study it. Study the Victorian internet. Telegraphy, how it changed the world. I think these guys have got it. And it may not be that company exactly, but it is called digital real estate. And real estate, most of the time, sits idle, is not used, and that's where you're going to make money. And you go to in any building, and the offices are not used. You know, the TELUS has a very interesting program I'm examining called Work Styles. I actually love it. Work from anywhere, but come together when you need to. And I think that's what WeWork is trying to get to. So it's not a digital company, I'll give you that. Not a technology company, it's a phygital company, and they're quite different. And I have no strong opinions on that.
Thanks, Eugene. We have about 2 minutes left. We'll open up to the audience. Any questions? No. All right, well then I would like to thank our panelists. I think each of you provided a very unique and different experience and perspective on disruption. Thank you for joining. Thanks.
Thank you, Amar, and all of our panelists. I really just have one criticism. I wish Eugene was more opinionated. Thank you. Thanks, guys. So here's the deal. This is your choose your own adventure section of the day. You have to listen carefully so you know what's happening coming up next. First, I want to just say one more time, there's a black BMW that is running in the garage, license plate BYZM289. I know we've been talking about climate change. Well, whoever's car has been running for the last 2 hours, please turn it off. It has one of Eugene's batteries in it. Yeah, it's going to be fine. Good. Thank you, sir. And now here's the deal. You have a few options. If all of that talk of technology disruption has made you hungry, please go head to the Lakeside room. Out that way, you can grab some morning snacks. You can grab a latte, a cappuccino, a non-conference coffee at the cafe by provided by Grant Thornton in the ballroom. And when you're in that ballroom, make sure you walk through, say hello to some of our exhibitors in the exhibitor hall. Of course, if you're interested in attending a morning workshop, I'm going to invite you to make your way upstairs now. They are Session A, Private Equity Fund Government, Establishing Best Practices, the Manager and Investor Perspective. That's presented by Vistra. It's in room 202A. Session B, Barriers to Private Equity Investment in a Small and Medium-Sized Business, presented by BDC Capital. That's in 202B. The workshops are going to be followed by the morning breakout sessions, and then we'll be right back in this room at 12:15 for our luncheon third plenary panel. It's going to be a good one. So have a great morning, and make sure you're right back here at 12:15. Thanks, everyone.
Yeah, I'll come with you. I'm going to go look at the BDC workshop, and then I'm going to do the intro for your panel. Cool. All right. Hi, Jesse. Jesse and Terry. How are you? Terry, good. Good to see you.
Tough job up there. Right? I wanted to congratulate you on your Trudeau interview. It was amazing.
Thank